Today, we're going to discuss about the insurance companies. And after this virtual class, you should be able to define what is an insurance company. Let's try to discuss what is the difference between a life and non-life insurance companies. What are the most basic types of insurance companies, or what are the most basic insurance they provide? So what are the different classifications of insurance policies that they offer? First, according to Investopedia, one of financial websites in the internet, the insurance sector is made up of companies that offer risk management in the form of insurance contracts. So the basic concept of insurance is that there is one party which insures, or the insurer, who will guarantee payment for an uncertain future event. So meanwhile, the other party is the insured, or the policyholder, which pays a smaller premium to the insurer in exchange for that protection on that uncertain future occurrence. So class, basically the insurance sector or the insurance companies, they do business by offering the risk management, and this product or services is in the form of the contract, the insurance contract. So basically, there are two parties involved in an insurance company, or insurance contract rather. So the first one is the company or the insurer who makes the guarantee. And that guarantee will be paid in accordance to their agreement, and it will happen in an uncertain future event, except for a death, which is a certain future event, but in a way, we do not know when we are going to die. All right, so it still can be considered as an uncertain future event. Although death is certain or death is sure, but the timing or the cause of death is not certain or is not sure. So the other party is the one who takes the insurance, being insured, or also known as the policyholder. So the policyholder pays smaller premium, smaller payment fee. So the fee is the premium, so that there will be a protection in case the agreed uncertain future event will happen. So class, there are three main groups of insurance companies, namely those offering life insurance, non-life insurance, and health insurance, or the health insurance companies. So let's discuss it one by one in order for us to understand the nature of these companies and their products specifically, or services. Life insurance companies, again, according to Investopedia, mainly they issue policies that pay a death benefit. So this is what I'm referring to when we defined earlier what is an insurance company. So this type of insurance deals or pays the beneficiary or the nominee when the policyholder dies. So a lump sum upon the death of the insured, so to their beneficiaries. It may be sold as term life, so the insurance may be sold as term life, which is less expensive and expires at the end of the term or permanent. But this is more expensive but lasts a lifetime, and it carries a cash accumulation component. So we're going to discuss some of the types of life insurance companies in order to know this entire definition. So they may also sell long-term disability policies that replace the insured's income if they become sick or disabled. So we have now a bird's eye view of what are the basic services or products of a life insurance company. So, but in short class, so this is a benefit upon the death of the insured. And of course, since the policyholder is now dead, so who will claim the lump sum? Of course, the beneficiaries. So what are the features rather of a life insurance plans? Some of its features are, if it's issued in the name of the policyholder, flexible premium payments, customizable features, customizable sum assured, payout on death or maturity, ability to assign nominees, and features on investment component. First, issued in the name of the policyholder. So the one to whom the payment or the agreement or contract is issued, and the one who is required to pay the premium or the fee is called the policyholder. So the insurance company must issue the contract in the name of the policyholder. Usually, there is a single or one only policyholder. But in some case, there is a joint life insurance, so it may be more than one. But normally, class, the policyholder is only one individual basis. Another feature is the flexibility in terms of the payments of premium. So the frequency and amount of premium payments are based on the choice of the insured. For instance, if I am the policyholder, I can pay on a lump sum or a one-time basis premium, or I can pay it monthly, quarterly, meaning once in 3 months, semi-annually, twice a year, or annually once a year. Personally, class, I have an insurance and I pay it on a monthly basis because this is my choice according to my capacity to pay my premium. So, and the amount of the premium, of course, it will dictate or it will depend upon on how much you want to earn during the maturity of the insurance. So the higher the claim, of course, the higher the premium. But since you have the choice or the option, you may choose a lower or higher premium payments depending on maybe on your salaries, on your expenses, so you can manage your budget. Customizable tenure. So depending on the needs and the requirements, the policyholder may choose the term or tenure of the plan. So for instance, this is a life insurance plan, of course. So the usual tenure or the term is the death of the policyholder, but there are some life insurances which will mature, for instance, when you turn 60 years old, 65 years old, 70, it depends. So you can talk with your financial advisor. Customizable sum assured. It is the payout that your beneficiary is supposed to get when you die. For instance, according to the contract, insurance contract, your beneficiary will receive 2 million pesos when you die. So the 2 million is the payout. The premium that the insured pays is based on the sum assured amount that he or she chooses. So if, for instance, you choose higher than 2 million, 3 million, let's say, so you will pay a higher premium on a monthly, or it depends on what frequency did you avail. Payout during death or maturity. So in a life insurance class, the only reason that a beneficiary will receive a payout is when the policyholder dies, or when the policy comes into its maturity according to the term or the tenure. So when the claim will be made on when the policyholder dies, it is called a death benefit. But when it is based on the maturity of the policy, we call this as a maturity benefit. Next feature, life insurance policies gives you the ability to assign nominees. So when we say nominees, these are the supposed beneficiaries of the insurance policy. So we may use nominees or at the same time beneficiaries. They mean the same. So the nominees are usually assigned during the purchase of a policy. Let's say I get an insurance policy today, so I must assign my beneficiary or my nominee as of this date. But there are also instances which the nominees may be chosen at a later time. Let's say I will purchase now, and then let me think of my nominees for 1 month. So it may be okay depending on the insurance company. And then you can also switch your beneficiaries. For instance, your first priority is your mother. So if you think, my father deserves to be as the first priority, so you may do switching. It also features an investment component. So this gives the policyholder the benefits that are being paid out when it matures. So the common life insurances and policies available here in the Philippines have this feature as well. So when it matures, for instance, when the policyholder turns 60 years old, so he will get a cash benefit or payout, because this is the investment component of the life insurance policy. So there are several types of life insurances. So what are those? Term life insurance, whole life insurance, universal life, variable life, funeral insurance, survival life, mortgage life, credit life, and supplemental insurance. Plus, term life insurance has specific dates to end, while the rates stay the same. So after the period, the policyholder can renew the term, but now in a higher rate. So the usual terms are 5, 10, 15, 20, or even after 30 years. So it depends. So when, for instance, you chose 10 years, so after this year, you will get your claim, or you may renew it. Let's say you want it to be 20 years, but you're now going to pay with a higher rate or a higher premium. Whole life insurance can provide coverage for the entire life of an insured member. That's why it's called whole life insurance, forever, until your last breath. It guarantees that the premium will remain the same and the death benefit is fixed, and the cash value will earn a consistent rate of return regardless of the situations that happen around. For instance, let's say the inflation will not affect your rate of return because it is considered fixed or consistent. Universal life insurance. It has very limited varieties but various features. This is the reason why it is called universal. It has several features. And therefore, the premium payments may vary. The death benefit may be reorganized accordingly. So there is a condition that it can be reorganized. And it usually has a cash value component. Variable life insurance. It offers permanent coverage, again with a cash value. The insured has the options which sub-accounts to invest, which will in turn determine how much cash value will grow. So if you chose a sub-account that is not well performing, so there is a chance that you will lose money. So that is why it is called variable life insurance. There are sub-accounts, several sub-accounts. So you're going to choose among the options. So it's up to you whether you will earn or you will lose, depending on the performance of your chosen sub-account. Burial and funeral insurance is also called final expense insurance. The only purpose of this insurance is to pay for the funeral expenses. And in this type of insurance, it usually does not need a medical examination for the policy holder. So this is a very specific type of insurance. So whatever will be the expenses during the wake, burial, and funeral of the policyholder will be shouldered by the investment or insurance company rather. Survivorship life insurance. It is a joint insurance policy, meaning it insures two people, like couples or spouses, husband and wife, for instance. The payout to beneficiaries will be made when both of them must have died already, not only one of them. So two of them must die in order to claim the benefits. If you compare this type of insurance, the survivorship life insurance, this is cheaper rather than taking an individual separate life insurance policy. So you may have savings if you choose this type of insurance rather than buying for individual plan. Mortgage life insurance. Like the death or funeral insurance, which only pays for the funeral expenses, this specific type of insurance covers only the balance of mortgage. So whatever will be the balance of mortgage will be shouldered by the insurance company. So the death benefit is for the lender, not the beneficiary. The payout might be the remaining mortgage or partial balance depending on the choice, the option, or the agreement. Credit life insurance covers a specific debt like the mortgage. Again, the death benefit is for the lender as well, not for the beneficiary. Because the beneficiaries here in both mortgage and credit life will not receive any amount. Instead, the one who lent them the money will be paid so as to have no problem with maybe properties or claims. Supplemental life insurance is also known as life group insurance. Rates of supplemental life insurance is based on group, not on individual basis. For instance, the employees of the specific company will have a life insurance. So this group and not on its individual capacity. What are the advantages of life insurance? It will give you financial protection for your family, to fit into your budget, peace of mind. To take a life insurance is very easy. In fact, this pandemic, I got my insurance using virtual approaches only. I don't need to physically get into the office of the insurance company. I also get my receipts of monthly premiums using my email. So very easy. There's no complexity in applying insurance plans. It completes your financial plan. Maybe you have already many or several plans, but having a life insurance will complete your package and it will help you save. Paying a monthly premium will force you to save, and your savings will get into the into your insurance. And if you have one, you will have a cash payout during the term. So see, personally, class, I recommend you to get an insurance plan as young as possible because of the benefits that you will get. So sooner or later, especially when you already have a job, please do get life insurance. It will help you a lot. Disadvantages, of course, we say that this is cheaper, but it may also be expensive. Because if you get an insurance at an older age, so you will pay a higher premium, or when your health status is not as good as when you were young. Why? Because the risk of being paid by the insurance company becomes higher as you old or as your health deteriorates. So while you are young again, while you're still very healthy, you do not feel anything wrong with your body, if you can, please do get insurance. If you're going to sum it up, the entire amount of insurance is expensive. For me, for instance, my entire amount until I become 60 years old in insurance is 756,000. So it is very expensive. But mind you guys, you will receive more than that. The benefit will far off better than the amount that you give in. And you will not realize this, especially if you are paying on a monthly or quarterly basis. So it may be higher, but you will not feel the great impact rather than paying it semi-annually or annually. So the cash value is a weak form of investment. And in some cases, especially when the circumstances are confusing, it might be misleading. But these disadvantages are being managed by the advantages which have more features rather than disadvantages. So we're through with the life insurance. We'll discuss the non-life insurance. The losses that are incurred from a specific financial event are compensated to the insured, and this is called non-life insurance being offered by non-life insurance companies. So general insurance, property insurance, and casualty insurance are also the other names for non-life insurance. It can be defined as any insurance that is not related to life insurance. So if it is not life, so it is technically called non-life insurance. People, legal liabilities, and properties are covered under a non-life insurance policy. So we give credit from this website, www.acco.com, from this definition of non-life insurance. Some examples of non-life insurance policies. Homeowner policies. So it is for the homes, the houses, the structures, the buildings. Motor insurance policies for the vehicles, marine insurance, calamity insurance, which is, I think, one of the most popular among these examples. Calamity when there is a fire, earthquake, flash floods, typhoons, travel insurance when you're traveling, especially in a farther place, accident insurance when you have an accident, when there's a theft, for instance, a crime that happened. So those are samples of non-life insurance policies. What are the features? There is a specific sum of amount to be claimed, of course. The term is usually short, but it may be longer. The premium must be paid first before they issue the policy. Portion of claims might be paid by the insured, and there may be a no-claim bonus. So what are the benefits of non-life insurance? It takes care of the property damaged or stolen. It will take care of people traveling including their baggage documents. For businesses, it will manage the insurance of their employee, shopkeepers, etc. So of course, the benefits will depend on what type of non-life insurance did you get. So we go back to the features. Let's explain it one by one. There is a specific sum of amount to be claimed. So just like the life insurance, so when you die or when the term matures, your beneficiary will get. Same with this. There is a specific amount that you will claim because you are still alive at this point of time. You're not dead. No? So if, for instance, you get insurance against robbery or theft, so once it has been settled already that you had a robbery or theft from your house, so it will pay back the asset or the property that was stolen from you if it was or it is the agreement. The value of the property, let's say 50,000. So it will be paid to you. The term is usually short. For instance, 1 year. One of the most usual term is 1 year, but it may be longer if that's your agreement. So if I take my annual insurance, so I will renew it if you want 1 year after, if that's the statement of the contract. The premium must be paid first before the company will issue the policy. For instance, the premium is 10,000. If you have not paid fully the 10,000, they will not issue you the policy. So you have to pay it first. So they will give you a certificate stating that you have already complied with and this is your policy. Some or parts or portions of claims might be paid by the insured. So there are instances that they will not pay you the entire amount because maybe it is the agreement or maybe at some point in time you have a fault as well. So going back to our example previously, the 50,000 insured property, in this case, you will just get 30,000. There may be a no claim bonus. When we say no claim bonus, class, when you did not claim for instance, this year, you have no claims in your insurance, the tendency is that you will have a no claim bonus next year. So the no claim bonus may be in the form of a discount on the premium that you pay or a higher insurance amount. You will pay the same amount of premium, but if you're going to claim, so you will get a higher amount. So that's the no claim bonus. All right. So the two basic type is the life insurance and non-life insurance companies. So, but let's also talk with health insurance. This is a non-life insurance, but it is very popular. It has something to do with us. And we need to learn this as well as a specific type of non-life insurance. So again, according to Investopedia, health insurance is a contract that requires an insurer to pay some or all of a person's healthcare costs in exchange for a premium. More specifically, health insurance typically pays for medical, surgical, prescription drug, and sometimes even dental expenses incurred by the insured. Health insurance companies can reimburse the insured for expenses incurred from illness or injury, or they can pay the healthcare provider directly. So in this type of insurance, the policyholder will pay a premium, of course. So later on, he can avail these services, medical and even dental services, if that is included in your contract. So the payment of the expenses can be done directly to you, or they will pay the healthcare provider or the health professional, the doctor, for instance. The health insurance is often included in an employer benefit packages. So when you work in the future, there is a big chance that you will land on a job which offer a health insurance package, because this is a way to entice, to invite quality employees, and the premiums partially covered by the employer, but often also deducted from employee paychecks. So it depends. And the cost of health insurance premiums is deductible to the payer, and the benefits you receive from this is are tax-free. So how does it work? Managed care insurance plans require policyholders to receive care from a network of designated healthcare providers for the highest level of coverage. If patients seek care outside the network, they must pay a higher percentage of the cost. But in some cases, class, the insurance company may even refuse payment outright for services obtained out of the network. So it depends on the type of policy you avail. So you have to study well first. What are their offers before you enter into an insurance policy or insurance contract? So usually, a healthcare insurance company has already designated facilities or hospitals where you can get your uh, health services. So if you availed on a non-accredited, non-affiliated hospitals or facilities, you will pay a higher percentage. But again, as mentioned here, there are some instances in which if you avail services outside their affiliated hospitals, they will not pay you even a single peso or centavo. Features of health insurance: free health checkups, daycare treatment, no claim bonus, OPD treatment, recovery benefit, daily cash benefit, restoration of some insured organ transplant, dental treatment and bariatric surgery, and attendant allowance. Let's explain this briefly. So one of the most common features of health insurance is free health checkups. But it is subject to a limitation, especially on the amount of coverage. So usually, the health insurance companies will say on how much can you go for checkups or hospitalization. It can be 100,000, 200, half a million. So it depends. Daycare treatment. So this coverage is for a treatment under general anesthesia in a hospital or facility, but less than 24 hours. That's why it may be termed as daycare treatment, for the day only. You will not be confined for several days, but only for less than 24 hours. No claim bonus. We have already explained this earlier. that if the policyholder did not file a claim for a certain tenure, period, or term, there will be an added advantage for the next years or period. Again, it can be a discount in the annual premium or the insured amount will be higher. OPD treatment. When we say OPD, outpatient department. So patients who are not confined in the hospitals, but they are at their homes, at the comfort of their homes. So this feature may include laboratories, cost of medicines, consultation, professional fees. So since this is an OPD treatment, it does not need a hospitalization in order to file a claim. Recovery benefit, it allows a lump sum to cover additional costs to prolonged hospitalization. So since the policyholder has been hospitalized, let's say, for several weeks or months already, so he or she will not be able to work, but the expenses are still rising. So to cover the days or weeks that the policyholder is not able to go to work, report to work, so this feature will provide you a payout for the number of days or weeks that you are not into your physical job. So you will have money or funds to provide for your expenses, especially if you have a family. Daily cash benefit might be like the recovery benefit, but the coverage is for the daily expenses of the policyholder, or his or her daily food or meals, his transportation when he goes to hospital for checkups, or his hospital visits. So whatever will be his or her daily expenses will be covered by this feature. Restoration of sum insured. If in case, let's say the maximum amount of your health insurance is 100,000. For a year, you may exhaust it depending on your medical needs. But your insurance may allow you to restore it to the original amount after paying, of course, the required premium. So let's say after a year, uh, it will go back to the original amount, which is 100,000. So it is now restored. Organ transplant may include the surgery costs of having an organ transplant, either as additional, it's just an added agreement, or it may pay you in full or in part, partial, depending on the agreement. Dental treatment and bariatric surgery. So this is a special inclusion for the dental needs of the policyholder, and bariatric surgery is for those people suffering from obesity. So it is a feature, but of course not for all health insurance. Again, class, let me just remind you that the nature of the insurance contract depends on your choice, on your option, the flexibility of your budget. So the coverage of an insurance from one person may vary to another one. Attendant allowance. So this feature is for those who accompany or takes care of a child when he or she is having a hospital visit or hospitalization. So the attendant of the child will receive an allowance because he or she might not be able to go to work because of the child's hospitalization. So what will the insurance company do? They will pay you the allowance. What are the advantages of having a health insurance being provided by health insurance companies? First, cashless hospitalization, especially let's take the scenario here in the Philippines. Some hospitals require a cash down payment if you're going to be hospitalized or your emergency case. In this case, you don't need to pay cash when you are hospitalized because your health insurance will take care of it. So if it's an emergency case, the usual remedy is that the hospital itself, its staff of personnel, will be the one to directly contact your health insurance company representative. Second, there are network of hospitals to choose from. You have plenty. No claim bonus, add-ons or riders. Because some health insurance class do not cater pre-existing illness. What are those illness? Those are diseases that you have acquired before way back before you take the insurance. So they will not going to reimburse you or pay you or the hospital if you have a pre-existing illness. But if you have these add-ons or riders, you may want to add a premium so that if you're going to be hospitalized using having your pre-existing illness, they can still cover it. Financial protection, this is very obvious. You will not find it hard to afford medical services because you have a health insurance, peace of mind, so it's more of mental, emotional, and affordable health care. Disadvantage. This is what I'm saying a while ago. It excludes pre-existing conditions or illnesses. Waiting period. So you have to wait for some time before you may be eligible to claim for health insurance. Let's say 30 days. Why? Why there is a waiting period? Because to avoid the circumstances in which the policyholder will just take a health insurance because he or she has a pre-existing illness which he or she does not tell or told the company. So to give the company the chance to scrutinize, to examine your true condition. Increase in premiums, this is reality. So yearly, the coverage will be the same, but you're going to pay higher in health insurances. And copay, meaning the entire amount will not be paid by the insurance company. Hence, you're going to pay as well portions of your medical expenses. So there are three types of health insurance companies, HMO, PPO, and POS. So HMO, it is a health insurance plan, or what is HMO first? Health Maintenance Organization. It is a health insurance plan in which the insurance company will pay the beneficiaries healthcare needs with specific doctors, hospitals, and healthcare facilities. So an HMO will pay the policyholder only to specify doctors, hospitals, or facilities which are affiliated to the insurance company. So you cannot just go anywhere and have your medical checkups or your hospitalization. Second, it usually has limited coverage in terms of network, benefits, and even in amount. So not all hospitals are HMO accredited. So therefore, your chances of having checkups or hospitalizations in the facilities will be lesser. So the benefits is also lesser in amount. There is a limitation. Usually, it does not cater healthcare needs outside their network, but in cases of emergency needs, so they will take care of you. They will going to pay the healthcare provider or the doctor. So this is reimbursement on their part because this is an emergency scenario. Health Maintenance Organization, or HMO class, is very common to employees. So when you're already at work, you usually will encounter this, having a health maintenance organization insurance package. The other one is Preferred Provider Organization, PPO. So it involves insurer and a network of preferred healthcare providers who agree to provide service at a specified or contracted price. It is a plan in which the insured will choose within the preferred providers and will pay in lower rates. So when we say preferred provider, there are several healthcare providers which they prefer. And this these preferred doctors or hospitals agree to give you a service in a contracted price, meaning fixed already. You cannot just change it, consistent. So your option only is to choose among these preferred providers. But the advantage is that you're gonna pay in a lower rate because there is already a contract between the health insurance company and the preferred healthcare service provider or even a facility. Finally, we have the POS, or point of service plans. So it is an insurance plan that offers different benefits, whether you choose an in-network or out-network service provider. When we say in-network, this is between, among the network of professionals and facilities that you're into. When we say out-network, they are not affiliated in one way or another. So POS combines the features of HMO and PPO. It will let the beneficiary pay less if he or she will use in-network services. So it will allow you to go into an accredited healthcare facilities, but you're gonna pay a higher rate. So it has a combination of the features of both HMO and PPO. All right, guys, that ends our discussion for today. I hope you learned many things and thank you for listening and God bless you.